So it's really important to get the right information on the economy because there's just so much out there, so much noise that could be a distraction. And there's a lot of people out there that will be selling you. Either they're trying to earn a commission or whatnot, selling you to buy in times when there's a lot of red flags. And it's really important to follow who to listen to, who's the right person, who are the ones who are, moving the economy and making the decisions. And it's not difficult to do it. You can definitely do it by getting the right information from the right people. Here's a shameless plug. You can subscribe to this channel, learn much about the economics and what's happening in the world, or you can check out our course on infovesting.com to learn about the economy and how that relates to the markets. When I look at the stock market, when I look at the bond market, the commodities market every single day, currencies, crypto, see what these main players are saying, what they are doing in terms of moving the markets, it makes a lot of sense. And I have my ears open to them rather than the ones who are trying to sell me a product to earn a commission. That's what's really important for me. That's how I view the markets and make my own decision. And for you guys, when it comes to, whether you're an investor or an entrepreneur, whether you're flipping Rolexes or cars or what have you, it's important also for you to get the right information and have the right idea as well. For those who are new, my name is Daniel and I run InfoVest. InfoVest is an organization that promotes the economy and macroeconomics news, that promotes on information, on studies, on how to read the economy and how that relates to the financial markets. Now, I'm not a financial advisor. I'm not a guru or any of that sort. I'm just, you could say, a nerd who likes this information a lot and likes to talk about it. Now, when it comes to learning and understanding the true messages, today I'm going to go over the true messages that come from the FOMC members. Really important to listen to what they have to say. And we've seen this before. Last month, right, and the month before that as well, the markets were pricing in some sort of pause or dovishness to come in the comments from the central banks, meaning heading towards a direction of rate cuts. But the Fed members, the FOMC members, came out way before the meeting, especially way before the May meeting, came out to basically throw cold water on that idea and come out and basically talk about that, hey, we could see higher rates, or we're going to raise rates in May, which they did. They increased it by another 25 basis points. Now we're getting the same thing again. Now things have changed in the May meeting. The statement has changed, that the language has changed more towards a pause. But it's still important to understand and read and hear from these FOMC members, because up until the next meeting, which I believe is in June, things can drastically change, especially when it comes to the data. So I understand that inflation numbers that came in the US came in line, right? It didn't come in higher. Now the jobs number did come in higher than expected, and we still have more data to view until the next meeting, the next FOMC meeting. But until then, it's very important to keep an ear and eye out on what the Fed members are saying, because that's going to be your clue, not some car sales agent who's telling you that, hey, the markets are going to go up and don't worry, you can afford this loan and this car payment, and then you can don't have to worry about what's to come next. But that's not what the central bankers are saying. Now let's go over some of the comments from some of the FOMC members, and most importantly, on Friday, Bowman came out very hawkish, which basically sent the stocks and bonds going down. And when we see that happen in the markets, we know that it most likely has to do with comments from the central banks, which again, Fed Bowman came out and spoke about. Now, what did Fed Bowman say? Fed Bowman said the policy rate will need to remain sufficiently restrictive for some time. Additional rate hikes likely appropriate if inflation stays high, labor market stays tight. Well, we got the CPI report. Now, CPI report was in line, so it's still high. We haven't hit the 2% target that the Fed wants, and the labor market is still tight. Well, yeah, the unemployment rate is at record lows, and we have yet to see deterioration in that data. Fed Bowman also said policy is now restrictive, so we are in restrictive zone, but uncertain if it's sufficiently restrictive to bring inflation down. So we're restrictive, we're creating tightening conditions, but is it really sufficiently restrictive? AKA meaning, do we need to tighten more? Now, the last FOMC meeting in May, Jerome Powell opened the door and left the door open for potential rate hikes that could come in. He didn't, yes, signaled in the statement that a pause is now in, but did not throw out the idea that rate hikes can't still go higher, that there's no rate hikes. You can still have rate hikes in the coming meetings if the data says so. And now, after that meeting, you have Bowman contemplating whether we're sufficiently restrictive, whether we still need to go higher. And Bowman also said policy action is not on a preset course. Recent data have not provided consistent evidence that inflation is on a downward path. So she's basically saying to you that, hey guys, wake up. She's a Fed member. She has voting rights. She votes on whether to hike rates or not. She's one of the many who does vote. And she's saying that the data is still not showing any evidence of it to come down. So in simpler words, they have to continue, like they've been saying, fighting inflation, bringing it lower, and yes, at the cost of your job, at the cost of many people's jobs, at the cost of bringing unemployment higher, at the cost of creating pain for the consumers and businesses. Now, that doesn't end here. Fed Bowman was one of the many Fed members out there. We also heard from Kashkari basically saying if markets are right, one would imagine rates could normalize. But he did come out and say, I'm not convinced we are at max employment. Inflation is too high. If markets are right, I've already said that, but if high inflation is more embedded, rates will need to stay higher for longer. And we did hear from Powell saying that inflation could be here to stay for some time, versus what he said before, expecting that we are in a deflationary process and that inflation will come down soon, especially this year. But basically he came out saying that, hey, that's kind of wrong. We're seeing that it's quite elevated and staying there for some time. Now, Kashkari also says data is driving my policy expectations. I am now on the more hawkish end of the Fed policy spectrum. He's more on the hawkish side of things, meaning that, he sees things more tighter than most of the Fed members there. He's also not seeing evidence of a crash in consumer spending or slower in services side economy, which means that if more spending continues, inflation continues to be elevated, that means it needs to be whacked by the central banks to create higher tightening conditions in order to bring that spending down, inflation down. That's their goal. Once this period of high inflation ends, we will be back in low inflation, low rate environment. Inflation is coming down, but it's pretty darn persistent. Again, talking about that it's not coming down, they need to do more. That means we will have to keep at it for an extended period. We have to keep at it for an extended period. What does that mean, keep at it? That means keep the markets tight. create the credit conditions to worsen off. And if they have to, hike more. Why? Why? Because they want to break the back of inflation. They're going to basically, I know this sounds bad, but they're basically going to break the economy, ruin the economy in a way to bring inflation down. It's as simple as that. Yet, a lot of people don't believe it. And that's okay. All I say is don't listen to me. Listen to what they're saying, the Fed members there. It's not me who's making these comments. It's the Fed. And yes, sure, the Fed is wrong. What they're doing is wrong and they're going to destroy everything and blah, blah, blah. Yes, totally understand. But you got to understand one thing also. That even though you may disagree with what they're doing, you need to keep an ear and an eye out to understand that, okay, if they are stubborn and continue to tighten higher for longer, something is going to break, the shit's going to hit the fan, and things are going to get worse off, which means that you should be prepared for it when it comes. And then last but not least, Kashkari said inverted yield curve put real pressures on the banks. And yes, we've seen with the regional banks, they've been under pressure, and we can see continuation of that pain. Now also another Fed member came out, Goolsbee, basically said inflation is still too high, but at least it's coming down. Hopes inflation can ease without a recession, basically saying that hope we can get there, but those words basically tell me that, hey, we need a recession in order to bring inflation down. Hope doesn't work. He also said Fed, so this comes out from on Monday. He also said that Fed must be data dependent. Watch the credit conditions. Getting vibes at credit squeeze is beginning. Trying to stabilize prices without hard landing. Recession is a possibility. This is a Fed member telling you recession is a possibility. I say we're already in a recession. Weighing how much Fed work is being done by tighter credit. Too early to make a call on rates for June FOMC. Should be especially attuned to issues in the bond market related to the debt limit. If there is no doubt the U.S. Treasuries that would increase bank stress, and U.S. Congress has to raise the debt ceiling. So overall, in this week, we had one after the other, back-to-back Fed members coming out, sounding hawkish. It's going to be really important to continue to monitor this, because if more come out, more of the narrative that, hey, we may have to hike in June, then, you're going to see some reaction in both the stock and the bond market, and it may not be good. And then the next question is, how long are they going to tighten for? Are they going to are they going to approach 6%? I think, if they do that, which is probably unlikely, but I could be totally wrong. But if they do that, I think something's going to break before then. I mean, we're already seeing the cracks. So let me know what you guys think. Leave a comment below, subscribe, hit the like button, the bell icon to be notified on the next video, and I'll see you guys around. Cheers. Bye.